We're back on Morning Movers. Delta Airlines in focus. It will be the first major carrier, U.S. carrier, to report a Q2 earnings tomorrow morning before they open. Analysts are expecting EPS to come in at just over $2 on an adjusted basis on revenue of $16.18 billion. Shares are more than 40% off of April lows, but still down more than 15% this year. Time now for Options Corner. Joining us to take a deeper look at Delta's Rick Ducat, lead market technician. All right, Rick, first up, let's talk about the trends that you're noticing on this chart for Delta.
Yeah, well, I mean, first of all, Delta underperforming the industrial sector and the broader S&P 500, starting to become more and more uncorrelated to the broader market here. You can see this is our 20-day correlation. But what's really interesting about this setup here is our yearly candle chart. If we look at where the price action is, mostly concentrated here in this area, right around 50 or so, centered around our volume profile, point of control, and all our moving averages that we follow. Yellow 21-day, orange 63-day, purple 252-day exponential moving averages. Stuck within a range, moving averages clustering together and moving sideways, low volatility. Sounds boring, right? But that's often the precursor to high volatility. So if we start getting a breakout above this red line here, 5350, an old high point, a recent high point, things could really start to heat up. RSI also showing a matching trend here, downward sloping, but on the verge of potentially breaking out.
Okay, so on the verge of potentially breaking out. So then when you look across the options market, what does open interest and volume look like for Delta?
Yeah, so to think about that aspect of everything, yesterday's volume in terms of the option market, about 84,000 contracts changed hands, 62% call, so more skewed toward that side. The sizzle versus the 5-day moving average of volume, 1.4, so slightly above average. Open interest for the July monthlies, the expected move is this shaded area here, about 46 to 56 or so, so about 5% plus or minus. The July monthlies, highest near-term open interest, 123K, but the actual two biggest ones are the September and January monthlies, so be on the lookout for interesting trades there.
All right, September and January standing out in that group. Thank you, Rick. That's our Rick Ducat, the Duke of Data himself. All right, I want to bring in Tom White, senior options contributor and co-host of Fast Markets, to take us through an example trade. So, Tom, what is the approach? I always get nervous. I'm not doing this, obviously, but when you're going in front of earnings, so what's the approach for an example trade?
Yeah, Diane, the option market pricing in about a plus or minus 6% move in the shares, just over $3 either way. Implied volatility levels are elevated, but as Rick mentioned with the chart, we've bounced off of those April lows pretty significantly. So that's lowered some of the, maybe the volatility that we typically see going into an earnings event. The bar's actually pretty low in this name. CEO Ed Bastian last quarter lowered this quarter's estimates and then cut full year guidance. He didn't give any, just due to the uncertainty. So if we see some better clarity on maybe the rest of the year in travel, that might actually help this stock here, because it is still off over 25% from those all-time highs that we saw in January. So I looked at a strategy, gives myself a little bit of duration, not a pure earnings play. I went out to the July 18th monthly options that expire in 9 days. And we're just going to buy an at-the-money call vertical here to take a bullish stance if you think this stock's going to go higher. Buying the 50-strike call, that's in the money. The stock's going to open up here around $51, so it's about $1 in the money. It's going to react more like the stock. It's got that higher delta. And then against it, we're going to sell the 55-strike call. So a bullish $5 wide call vertical. You're going to pay roughly about a $2 debit for it. That's going to be your risk. $200 per spread with the available profitability. If this thing expands above the $55 level, it's going to be worth $5. So you've got a pretty good risk reward setup on this. That break even, $52 to the upside, that's only 2% above the current share price in there. So you don't need that monster move to the upside. It's well within that one standard deviation of about $3 either way. So you've got that working for you as far as probabilities. Now, why do you sell the 55-strike call against the long 50-strike call? Well, it's to offset some of the risk, lower that break even. It's about 8% move to get above that 55% level, but you're giving yourself duration, right? You got a week and a half in this position as opposed to just a pure earnings play on this one. But this might be the setup. If you get some good news out of Delta Airlines, this is the best run out of the airlines. It's got the best balance sheet. Their luxury is doing well, international business doing well also. So if you think this stock's going to go higher, this might be the way to play it.
All right, that's an example trade for Delta Airlines. It's got earnings on tap for tomorrow morning.